All right, let's get right into it. We're going to talk about something we all use every single day, but almost never see: how money actually moves between banks. Think of it as the hidden plumbing of our entire economy. And today, we're going to see exactly how it works.
I mean, we do it constantly, right? You pay a friend, you pay a bill, you buy something online, you hit confirm, and the money's gone. But have you ever really stopped to think about the incredible, almost instantaneous journey your money takes right after you click that button? Well, it's not magic. Your money is entering this massive, invisible network. It's a complex web of rules, computer systems, and institutions, all working together behind the scenes. And I know it might sound complicated, but I promise, by the end of this, you'll have a super clear picture of how it all fits together. Okay, so to understand the whole system, we have to start with the absolute simplest case you can imagine: moving money when both people use the very same bank. This is called a book transfer. And honestly, it's about as simple as it gets. Just think of the bank making a note in its own private diary. No real cash has to move anywhere. No outside networks get involved. It's all just an internal accounting trick. A simple change in the bank's own records. Let's make this real. Imagine Alice and Bob both have accounts at, say, Chase Bank. When Alice sends Bob $100, all Chase has to do is make two little updates in its database. It subtracts $100 from Alice's account and adds $100 to Bob's account. That's it. The money never even left the bank. It was just moved from one column to another on their spreadsheet. So here's the really crucial point. These internal transfers, or on-us transfers as the banks call them, are basically the gold standard for efficiency. They're instant, they're either free or incredibly cheap, and they are perfectly safe because there's only one institution involved. Every other more complicated payment system is really just trying to copy this level of speed and simplicity. But of course, in the real world, we don't all use the same bank. So what happens when Alice uses one bank and Bob uses a completely different one? Well, this is where the plot really thickens. And this brings us to the central challenge, right? How can Bank A just reach into Bank B's computers and change its records? The short answer is, it can't. They're totally separate companies. Bank A has zero authority to mess with Bank B's books. So they need some kind of trusted middleman to stand between them. This middleman acts as a central hub for everyone. It's kind of like an airport. Instead of having a direct flight from every tiny town to every other tiny town, you just fly to a major hub, like Chicago or Atlanta, and then connect to where you're going. Banks do the same thing. They don't all connect to each other directly. They all just connect to one central, trusted point. Okay, so this brings us right to the heart of the financial plumbing: the different systems banks use to actually pay each other back for all our transactions. And it really boils down to two competing models. The first way is called a net settlement system. The easiest way to think about this is like keeping a running tab with your friends all night. Instead of paying each other back after every single round of drinks, you just wait till the end of the night, add up all the IOUs, and whoever owes money pays up in one go. Payment systems do the exact same thing, just with billions of dollars. Now, the real genius of this is something called liquidity efficiency. That's just a fancy way of saying banks don't need to have massive piles of cash ready to cover the full value of every single payment. They only need enough cash to cover their final tab at the end of the day. This frees up a ton of money and makes the whole system run a lot smoother. The other model is the complete opposite. It's called real-time gross settlement, or RTGS for short. With this system, there's no running tab. Every single transaction is processed and settled on its own, for its full amount, the very instant it happens. So what's the point of that? Well, the huge advantage here is safety. Because each payment is final and irreversible the second it's processed, it completely eliminates the risk that a bank could fail before it pays its debts at the end of the day. This gives you absolute certainty, which is so important for really big, critical payments. And this right here perfectly illustrates the fundamental choice you have to make when you're designing a payment system. It's always this trade-off between efficiency and safety. Do you want a system that's cheaper and needs less cash to run? Or do you want one that is rock solid, perfectly safe, and eliminates risk? We can actually see this trade-off in the major payment systems used in the US. First, you've got ACH. This is the workhorse for everyday stuff: your direct deposit paycheck, your automatic bill payments. It's a net settlement system, which is why it's super cheap but might take a day or two to clear. Then there's CHIPS, another net system, but it's for huge international payments where that liquidity efficiency is a massive advantage. And finally, you have Fedwire. That's the Federal Reserve's RTGS system. When a giant, time-sensitive payment absolutely positively has to get there with zero risk, like for a corporate merger, it goes through Fedwire. It's not as efficient, but it gives you that absolute finality.
Okay, so let's get to the final piece of the puzzle that holds this entire thing together. The linchpin of this whole architecture is, you guessed it, the central bank.
The simplest way to think about it is this. Just like you have a checking account at a commercial bank, all those commercial banks have accounts at the central bank. And it's in those accounts that the final, official settlement of money between banks happens.
The central bank really wears four crucial hats here. It's the ultimate settlement agent, the final scorekeeper. It often operates the most critical infrastructure, like that RTGS system we talked about. It's also the overseer and regulator for the whole payment landscape. And finally, it can step in and provide cash or liquidity if the system ever starts to seize up.
So when you look at all those different roles, operator, regulator, banker, what is the single most important thing the central bank brings to the table? What is the one function that makes everything else possible?
Trust. By providing a totally risk-free asset to settle debts with, that's central bank money, and the infrastructure to move it, the central bank creates the bedrock of trust that our entire financial world is built on. A commercial bank might fail, but the central bank can't. And that certainty, that absolute trust, is what allows billions of dollars to move securely around the world every single hour of every single day.